Right, so I'm gonna so I'm gonna start today with revealing some of the market movers, what's going on. Um, okay, after what's been happening this week is the Fed raised the interest rates 25 basis points on Tuesday. So um, they're being very aggressive with trying to resolve the situation with inflation. And we've been saying for a while now that there's a correlation between rising interest rates and the premium that you pay for stocks in the stock market. So as the interest rates go up, the premium you pay for stocks goes down, especially growth stocks. So let's look at our picture of the S&P 500. Okay, so right now we're at a situation where we're at we're making higher highs, higher lows, but we're still in the trading range, and that's well, right now we're at the bottom end of this trading range, so we can assume we're going to be going like this, going higher highs, higher lows. Well, something major happens, and that would affect the economy, such as if the Fed keeps on raising interest rates. But the pattern right now seems to be going up. And so we have a really big test right here. That's around 4,200 in the S&P. Then we break out of this long-term sideways market. So we had this earnings season. Let's look at our chart, our meeting notes here. Okay, so we're basically almost out of the earnings season. We had tech earnings, we had Apple earnings this past Thursday, and we're almost about done with earnings season. So and May is traditionally a really good month for the stock market. So we like to have that up in our top of our minds. It's primarily because the earnings come out right around the 1st of May. So that's a good reason for stocks to go up. And okay, so we don't know what's going to happen with the effective inflation rates and how that affects the premium people pay for the stock market. It seems like the earnings for most stocks aren't going up; they're going sideways and not increasing year over year. So that's why you have to assume while we're investing this year that pretty much things are going to be sideways. Like the charts. That's why for every chart in our stochastics charts, I update this every week. For every chart, I'm making two charts. One is a sideways chart, and a chart where we have higher highs and higher lows. And for almost every one of these stock charts and index charts we're following, we have upward momentum, but we're still in this sideways movement. So let's look at each one of these. Okay, so we have the higher highs, higher lows, but we still have like a sideways pattern forming. So I wouldn't be too surprised by the end of the summer. We're going to go into a summer doldrum time. And if we look at this, right around August, September, those are typically bad months. It wouldn't surprise me if we stay in a trading range like this for the rest of the year. I'm not sure. That's why we're drawing both charts. We don't know which way it's going to go. So it could go higher highs, higher lows. And that all depends on interest rates and how the earnings come out, because the stocks follow earnings. And if the earnings come out better than expected, we're going to follow this channel upwards. Otherwise, if the earnings estimates are flat like they are right now, it'll just be sideways. So that's a good way to look at things. All right, let's look at our meeting notes. Okay, what we have today and tomorrow, we had earnings come out for Apple yesterday, and they were better than expected. They're basically their sales are down 3% year over year, and the earnings expectations were lowered to a point where they could beat them. So that's the way it happened with a lot of stocks this earnings season. Their expectations are lowered, and they beat the lowered expectations by a little bit. So what we have yesterday, today, and tomorrow is basically an Apple kind of. Well, tomorrow there's going to be a Berkshire Hathaway meeting, and everyone, even the best investors in the world, love to see and get advice from Warren Buffett. And right now, 40% of his portfolio is in Apple, and he's going to, of course, be asked about, why is he holding, why is he selling, and he's basically going to say Apple's an awesome company. I'm never going to sell that, and it's 40% of their company right now, and that gives a lot of the money managers out there. Well, maybe he knows something more than we do, and that'll help Apple in general in the next month or so. We'll go over Apple a little bit later on today, but right now we have this banking crisis this week. I'll explain a little bit more what's happening there. We had regional banks going down a lot, and it seems like what happened is there was a lot of professional money managers that are shorting the regional bank ETF, and what that does is that forces those ETFs to sell every stock in that basket, and a lot of the regionals were going down because of that, and it was a self-fulfilling prophecy. If companies like PacWest were going down 90%, then people lose confidence and there's bank runs. So they're trying to stop that now, and that's why today was like a turning point in all that. So I'll explain a little bit more what's going on later on with that. But we're almost done with earnings reporting season, and in general, the stocks have reported better than expected, lowered earnings. So that means the company's earnings were lowered by the forecasters, and they did better than the lowered earnings estimates. So big tech stocks were helped by the weakening dollar, and the Fed is near done raising interest rates. We just had a report today about the labor that basically said that the economy is super strong. So we might not be done with the end of tightening. So the higher the interest rates go up, the harder it is on the tech stocks and growth stocks. Okay, so the 10-year and the 2-year are going down, and that's it's really interesting that they're going down while the interest rates are going up. So there's a mismatch there. It very well could be because of this debt crisis we have with the U.S. government, where if we default, there's a lot of no one wants to commit to a long-term bond in the United States, so that's why maybe short-term are going down a lot. So that's like an anomaly. We just have to ignore it because we're not smart enough to figure that out. We're still worried about this default. There's a 99% chance we're not going to have a default. Or the president will say we're going to extend the debt deadline. So something like that will happen. We're not going to default. It's just the market's getting a little worried. All right, so we do have an interesting thing. We've been saying that the competition for stocks are these 4% returns on risk-free returns like money markets. And Apple came out with a money market solution, I think last week, and they're paying 4% on the money market. So that means, and they got a $1 billion in deposits in a couple of days. So it looks like Apple's starting to turn into a huge financial type of a company, a fintech. And this could be taking deposits away from the banks. And that could be causing some of this run on the banks recently. So we do have competition for stocks, this 4% return, but that 4% is going down. This week it went down 1.5%, 4%. So it's not going to be like that forever. So people will switch back to stocks when it isn't attractive. All right, so let me see. So the stocks, starting to trade above their 200-day moving average, and that's an indication of momentum. We have fear starting to come back in the market. We've been going from greedy to semi-greedy to now neutral, and next phase after that is fear. But right now we do have momentum. So let me see. That's a good. Okay, do that. We're going to keep an eye on gold too, which usually does good whenever there's uncertainty in the world, and especially with the U.S. dollar. As the U.S. dollar goes down, gold should go up. Right now it's not doing much. Let's see. Okay, so right now we had, I think the price of oil should have. Let's look at what it did today. All right. Okay, we're gonna look at the what oil is doing. So right now we had a sign that the economy was strong. If the economy is strong, that means there's going to be a heavy demand for oil. And so it's a 1-to-1 correlation. If the global economy is strong, the price of oil goes up. So we have price of oil going up 4% today. So there's these good numbers for the economy. Let's see, let's look at what the numbers are saying here for there's a payroll report. It's strong jobs report. That means the United States economy is doing really good. That means there's going to be more demand for oil in the United States, and a lot of times the rest of the world follows the United States in the global recovery for the economies of the world. So that's why the oil price is up, and now the oil stocks, I bet, are all up today. So this is pretty low. This $71. We've been saying for a while around 70 is like a low for, and then once you get up to 100, that's like a high. So it's going to be going between those two. Okay, let's see some of the news that's going on. Apple.
One big drag on oil.
Oh, say it again.
The one thing on oil is that the OPEC Plus said they're going to cut, but their cut date is not happened yet. So they're still producing right now. And so that affects, prices may go up once they actually stop, if they actually start doing cuts.
Right. And so the other thing is if we get through this debt limit problem, and we somehow come up with a way to extend the debt problem, or we will start buying from the U.S. Petroleum Reserve immediately. So if you have a high demand there, then the price of oil is jumps. Or does it? Is that true? Wait, is that true? No, the price of oil will go down if the United States starts buying. So I don't know. We'll see what happens with that debt limit. That might have an effect on the demand for oil. So it's all supply and demand. We're not smart enough to figure that out. I don't think anyone is. But you just have to keep in mind that the biggest factor in the price of oil is the economies around the world. If they're strong, then there's a high demand for oil, and the price of oil goes up. And of course, the amount that they produce is the other part. The world oil producers. So, but this all affects the price, the inflation, and the price of things, cost of goods sold. So, okay, so it's down 7%. It's up 4% today. So, let's look at inflation. It hasn't changed anything. Dollar index is pretty much unchanged, and gold is up 1%. So we don't have a whole inflate the quality right now, but if we have some kind of debt limit problem and we default on our debt, this price of gold would go like 3,000 probably or something like that. Because the whole world will move away from the United States dollar for reserve currency. But we'll see what happens. Okay, so stunning beat. So the economy is super strong, and we had, hold on. Okay, Guan Yu was saying, he said, so I guess the Fed will continue increasing the interest rates. That is true. And it very well may be that, well, for me, looking at this, I just look at the, this is a year that we're consolidating and not doing anything. And we're looking forward to the getting out of this interest rate problems. But it could very well be raising some more. Let's look at the fear and greed index. We're at the neutral right now. So neutral. Oh, neutral is we were agreed last week and agreed before. We're going to neutral now. When people get to fear and extreme fear, that's the time when you start looking for really good bargains. But right now we're at neutral. So you see VIX. VIX was at 17, now it's up at 18.59. And the reason it went up a little bit was people were afraid of a banking crisis this week. So, but that's pretty much, I think it's played itself out. Like today is a good indication. We had some banks coming out saying, like JP Morgan said that this whole banking crisis is overdone, and it's upgrading some stocks in that regional bank index. So I'm going to go over that regional bank index a little bit later on. Let's do it now. Let's look at that. Okay. There's a regional bank index. It's an ETF for all the regional bank holdings. And what seemed to be happening is some of the big names were shorting this index. And whenever you short a ETF, these shares of these companies had to be sold. So it seems like there was a forced pressure on a lot of these, and that there were the investing public were thinking, oh, that's another regional bank failure. We better get out of this. So it's a self-fulfilling prophecy, and the White House was considering banning the shorting of financial stocks and ETFs. And as soon as that talk started happening, people are covering their shorts, and all these stocks are jumping on that. So that's what seems like it seems to be happening right now. We don't understand these bank stocks, so it's really hard for us to jump in and understand this.
To be sure, White House talked about that before during the last financial crisis, but nothing happening. So I don't think it happens soon.
Yeah, well, a lot of times they just talk about it. Sometimes talk is good enough to trigger short covering, and maybe that was part of why they said that. Because if there's a threat that they ban the shorting of these ETFs, then everyone has to cover immediately, and then some people did that ahead of time. Oh, I got enough. I got my 90%. Or whatever it was they were supposed to make, and that could be what's happening today. But I don't know. But it's affecting the confidence in the stock market. So you have the fear index. That's starting to recover, and I mean, people were super fearful about a banking crisis earlier this week. Now people aren't fearful anymore. So I think that's what happened this week, and now that we're the biggest problem with all of these regional banks going under, it kept on going like it was this week, is 70% of the loans in America were issued by these regional banks, and that could really affect the economy. So I think today could be a turning point in all this. So we'll see. It's not something I could really understand enough to buy any of those stocks. All right, so we have our talking points. Let's look right now at. Go back to the stock market to see what's going on with all these. Look at the percent gainers and losers. Of course, we talked about oil is probably up, and we know the bank shares are up. So 90% of these are bank shares, and all right, these are things I don't understand enough to buy, so I'm not going to look at them. But today could be a turning point in that whole bank issue problem. Let's look at the ones that are doing the worst. I don't know any of these stocks. Really, I don't. So I can't really tell you anything about that. Nope, I can't. All right, so let's look at the NASDAQ. All right, well, we see a combination of high PE stocks. We see Tesla, Lucid Group, EV stocks going up. Of course, Apple had their earnings yesterday. They're better than expected. And we have CrowdStrike, Zscaler. So these are computer security stocks, and NVIDIA. Okay, so AI is a really hot topic. And what happened yesterday was there was AMD is teaming up with Microsoft to make AI chips, solution for AI, and that hurt NVIDIA because they're selling AI chips too. So you have a whole lot of excitement around the AI world right now. And they didn't talk about the AI, but they're interested in that too. So I guess the commonality in that is EV and AI. Let's look at the ones doing the worst. Okay, I think the things that these have in common are inconsistent business models. We saw Intel. They weren't included in the deal with Microsoft, so AMD is going to pick up share for AI chips. If Microsoft partners with AMD, then Intel's left behind. So they're not going to be doing as well in AI chips. Intel, that's one bad thing. We see, Intel, and we know from Intel that they had inconsistent earnings over time. So they had a bad quarter and a good quarter and a bad quarter. So it's not as predictable. The good thing, the reason Apple is up today a lot, they had earnings from their App Store and their services business is more than most of these companies alone. So Apple is like a cash generating machine, whereas a lot of these companies in this lower list are inconsistent business models, like Booking Holdings. The demand for travel, goes up and down. And let me see what other ones are inconsistent.
I'm surprised that the airline go up, but Booking go down.
Oh, yeah, we looked at the airlines yesterday. I didn't have time to go into detail on that, but there seem to be really good growth rates in all those airlines. But Booking Holdings, there's not that much competition with Booking. You have Expedia, you have Google is doing a little bit of that. Google actually owns the database for all these companies that they use for booking. So Booking, Expedia, and Google Flights, they all use the database that Google bought for determining, what the lowest price each of these places are able to provide. So, I don't know. This is one of the stocks. Booking Holdings is a stock that's held by Ingrid Hendershot, and So whenever a stock like that goes down, I like to look at it. But right now, it's I don't have an advantage in understanding that business model. Let's look at. Okay, so we can't get anything else from this. Okay, so I guess the good thing about these CrowdStrike, and you have Zscaler, you have, okay, these are, you have a steady demand and consistent cash flow. So once you buy you decide on a company for your security needs, you don't really change that, and you're renewing very consistently. And as we have front page news stories about, oh, we have another hack, that demand makes these companies grow a little faster. Okay, so, all right, so let's look at the Dow. Okay, so we know oil is going up because the price of oil goes up 4% today. And, oh, you look at the stocks that did good these are all conservative stocks that did good last year, and right now they're underperforming. So I guess what you see from just the Dow is the things that performed bad last year are continuing to do good this year. And the ones that did good last year are underperforming this year. These are all stocks with high dividends and low growth rates. And they're safe, typically safe in a recessionary environment. It seems like that payroll report says we're not really going into a recession. And our economy is strong. And that's given a boost to a lot of the stocks in the Dow that are more growth oriented. All right, so let's look at, okay, so the stock market's pretty consistently up today across the board. So there's a lot of momentum and participation in each one of these indexes. Let's look at, okay.
Isn't it green today because it went down yesterday?
Perhaps. Perhaps.
Big died yesterday.
We don't know. We really don't know. All right, so I'm trying to get to a point. Okay, so let's look at, I have some talking points. Okay, so it seems like right now we're at neutral, returning to normal, and we might even be, we're probably at a point where we're getting media attention. We'll go over this a little bit later on. Let's look at, hold on, let me get this. Okay, this one guy in this article, this YouTube video, it's really good. You can click on this. I'll send the meeting notes to everybody. But this guy says the VIX is signaling a return to GERF trade. Greed eventually replaces fear. So what we have right now is we have media, the CNBC is saying, look, stocks are starting to turn. We're at the end of a rate hiking cycle. It's time to get back in. People are flooding into tech stocks, and as the interest rate sensitive stocks, now we've reached this peak. Now people are that sold out at the low are now starting to think, well, maybe it's time to get in. And so this guy basically says tech stocks are overvalued right here. That doesn't mean that people can't, get greedy. So this guy said that where non-bank financials are good sectors to be in, such as insurance companies not lending to customers. So he marked the insurance companies and fintech are companies that are not affected by lending to customers. So, keeping this in mind, this GERF trade that's happening now, greed eventually replaces fear. Let's go back and look at this. Okay, so we're probably right here. Media attention. We're starting to get some attention. People are starting to say, oh, no more interest rate hike. We're almost at the end of the interest rate hikes. That's going to be great for the tech stocks. People are going to be greedy. So we're starting right here in the media attention. So you got to keep that in mind. You got to have a neutral mindset when you're investing. And I saw a good thing on Twitter the other day. Where is it? There it is right here. you have to decide what you focus on. You could decide on days. Like every day it's up and down and up and down. Oh, I lost money and not. Oh, or you can look at the big chart. The big picture, which is over decades. Whatever you're invested in is going to be going up. I did a little chart here of the S&P 500 going back to 1991, and you can see these little blips in the screen. This is the year 2020 with the COVID lockdown, and you can see that we have a line going from the bottom left to the upper right in over a 10-year period, 20-year period. So you have to have this big picture when you're investing and not be too concerned about the day-to-day ups and downs. And Warren Buffett would basically say, you got to keep track of where a company's going to be in 10 years, and there has to be consistent demand for a product in 10 years or 20 years. All right, so let's go back to what I was talking about here. Okay, so the VIX is basically going to go back down to 17 again today. So we have a certain amount of complacency, and where it's at right now, we're in a bull market, and that's people are not fearful. They're not getting protection for their positions, and they're turning more optimistic. Okay, so that's where the GERF, growth, eventually replaces greed, of fear, happens, and then there's fear of missing out. Okay, so now this is a funny article. The Fed had two choices: no rate hike and you stop inflation. So if you have no rate hike, you have soaring inflation. If you hike, you risk a banking crisis, and that's where we were at Tuesday. And I think the Fed basically decided to raise the rates, kill inflation, and deal with all this banking crisis, which might be working itself out today. I don't know. All right, so I'm going to go over Apple real quick. Apple had an earnings beat on yesterday. The beat lowered expectations, and I didn't expect too much out of Apple this year, because basically year over year, we look at Apple, year over year, it's down 3%. So if you divide the earnings estimates or the actual earnings from last year to beginning of this year, you come up with a negative 3%. And so this one guy saying Apple's Q1 revenue was down 2.5% year over year. Second straight quarter of negative year over year growth, and Apple is not a growth company. So yeah, indeed, we didn't. That's why I expected the Apple chart to be sideways, until they resume a certain growth rate. And so we're at the top of that range. Like as of today, we're like right here, and we could go up here and follow this higher highs, higher lows, or we could sink back into this. It all depends on what the earnings estimates are. We'll keep track of these earnings estimates for Apple. Right now, they're estimated to grow at 9% average for the next 2 years, then 6% after that. So let's say it's growing at 9%, and the PE is 28. That means the PEG ratio is, you divide the PE 28 by 9. That means they're 3 times overvalued right now. But the reason why they can trade for this 3 times, so their actual fair value is $57. But the reason I own it is they're consistently growing. You can see that if you pull, we don't only have it going back 3 years, but if you have it going back 10 years, it's like a straight line up. So they're consistently growing, whether it's only 9% now, but still, they said they have 1 billion active users. And if they offer services to these 1 billion users to catch on, like advertising, or some kind of service that allows them to advertise, and maybe a service that right now they're doing the banking, where they're giving a 4% yield, and they got $1 billion in deposits in a couple of days. That kind of services for 1 billion people adds up after a while. I think that's why they're given. That's why they're selling for 3 times what they're really worth right now. So it's good to check in with that every now and then, because you don't want to get over your skis if a company's not going to be growing in the future. All right, so I looked at the Apple statistics. They're almost a $3 trillion company now. So just think what you can do with a market cap of $3 trillion. You can basically get into new areas, services, and then give those services to, sell those services on a monthly basis to their customers. So that's what their main business model is right now. And selling iPhones is services and iPhones. They're 2 main money makers. They're trading for a really high PE, 28. And the PEG ratio, that matches our estimates, around 2.85. And these are the most important parts. They have a return on equity of 147, which is really, really good. A profit margin of 24%, and they're and they have, I think they have, those are really important. That all matches what we're looking for. So I already mentioned this. The VIX is, we could be turning into a fear of missing out rally right now. Let's see. Okay, I'm going to turn to this article on Eli Lilly. There's a big amount of fanfare about new weight loss drugs. There's Eli Lilly has one, and there's 2 other main competitors. And obesity drugs could be the biggest type of drug in America pretty soon. And Eli Lilly might be selling one of the best ones. It's not easy to have a safe and effective obesity drug, and it's never happened, and Eli Lilly might have that. So another thing that Eli Lilly had announcement this week was they had good information on their trials about their Alzheimer's drug. So Alzheimer's is one of the biggest markets for a drug. And if Eli Lilly can come up with a drug that works, that could be the best-selling drug of all time. Next, obesity drug, which could be the best-selling drug of all time. So what I did was I took a look at Eli Lilly and see how their earnings estimates are changing, and they're actually going up. So I have a small position of Eli Lilly right now, but as it's going up, it's actually becoming a bigger portion of my portfolio. So I have to keep track of these things and see if it's see the earnings estimates and see how they're growing. Right now, Eli Lilly has and a good thing about looking at different sectors, like drugs aren't as reliable maybe as tech, because you have drugs that fail, and then traditionally in this sector, this drug sector, you have stocks that go down 20% because they missed a trial performance benchmark or something, and then they'll go down 50%, and then if they have a new drug that's approved, it goes up 100%. So it's very super unreliable, but it's not as reliable as maybe Microsoft or Google or Apple. But if you have a blockbuster drug, that really allows you these earnings estimates to go up. So this Eli Lilly seems to have 2 of them in the making. They might have an Alzheimer's drug at the end of this year approved. So let's look at their earnings estimates. I divided 22 by 23, and I got 10% growth. Okay, now from this year to next year, I divided these 2 numbers, and I got 28%. Then it goes down to 27%, and then maybe 18% the year after. So if they're growing at 28%, their PE is 46. You divide 46 by 27, and you get 1.7. So they were a PE ratio of 25. No, the PE ratio, PEG ratio 2 to 3 last year at this time, but now it's getting to a point where they're almost fairly valued. So it's with all this momentum with their drugs, it's let's look at that stock now, just for, see how it's doing. And the reason why I'm also looking at this other stocks like Eli Lilly is, well, Jim Cramer likes it. He always mentions good things about stocks, and it's up to you to do the research to make sure it makes sense to you. Let's look at the full chart on Eli Lilly now. Okay, you can see in the past month or two, it's gone up like 30%. It was in this little trading range, sideways trading range, and it's gone up a lot recently. It's overbought. But the reason why I started looking into this company is because I don't have much healthcare in my portfolio, so I wanted to balance it out. So I had a little bit of every sector. So sometimes if you have all the tech stocks going down like last year, you'd have some part of your portfolio going up, like the drug stocks, and this actually pays a dividend too. So this is if you look at the high, we're going to start tracking this stock because I think you can see it's making higher highs and higher lows. It's at the top of, let's do a quick chart of this. So this stock seems to be growing 20 to 30%. Okay, so we're going to do a quick. Seems like it's following this channel right now, and we're at the top of that range. We're like out of that. We're right here right now. It's probably going to go like this as news comes out about its stock and follow this pattern. So it looks like T-Mobile almost, and it's rate of going up. But these are all. I think it's going up because of these momentum with their drugs. So right now my portfolio has like 5% in drug stocks. So I think it's a good way to diversify your portfolio. You're paying, maybe double what it's really growing at, but it's going to be consistent because people buy drugs because they don't want to. They want to help their health. So let me see. What else can we? Is there any question? Any stocks anyone wants to go over real quick? All right. So no for that. Look, I'm going to go over to Stochastics. We do this like once a month, just to see what the ranges are for the stocks we're following, so you don't get over your skis, and this kind of tempers your expectations. There are people on the internet that say 100% of these charts that people make are inaccurate, and they don't even work. It's hocus pocus. So maybe it doesn't work. We're just trying to make sense of it. And I think in general, what we do is we try to make these ranges just so that if we're interested in buying a stock, we buy at a low. Typically, when you're looking at a stock pattern, you want to buy at the bottom of a range, like right here, and then you want to sell or don't buy when it gets to the top of that range. You buy and don't buy. So it looks like every sector and every stock, I'd say 90% are following this pattern right now. So if the S&P earnings are flat for the rest of the year and they're not growing, then we're going to be following this pattern. But if we have some growth, it looks like we have enough momentum to go into this uptrend. That's why I charted out both for every index and every stock. So let's look at S&P. Okay, it's following the pattern we understand. It's going to take a lot of good earnings to make it go up like this. It won't be 3 months until we get earnings again. So that's going to be tricky. So let's look at our earnings reports. Every 3 months we have earnings. So April, May, June, July. It won't be until July do we get earnings. And that's why we have, green. July is a good month because earnings come out that month. All right, so let's look at what else is that? That's S&P. The QQQ basically follows the S&P. So you can see both of those are following each other. It's almost exactly the same. The gold shares in the same pattern, and we're basically hitting the top of, both of these channels at the same time for most of these ETFs and stocks. So aerospace, it's high. Looks like we're stuck in this trading range right now with no momentum at all. Maybe if there's some kind of indication of more activity of war for the United States, this will break out. But right now it's in the trading range. XLY doesn't look like that's going to be breaking out. It's going to be sideways. That's why today the XLY oriented stocks like Procter and Gamble, the safe drug stock, the safe stocks that are consumer staples like the safe stocks that customers use every day, those are not going to be performing as well this year because right now with interest rates, people are more excited about growth. All right, so now let's see materials. Same chart. We have upward momentum, but in general, we're still in a trading range. All right, so XLC, same thing, same chart. These are stocks that have a higher PE. They have a higher dividend, but they're not growing as much. Let's look at healthcare. These performed really good last year, but this year they're flat almost. And there's probably going to be just stuck in this trading range. So everything that worked really good last year or didn't go down last year, they're going to be sideways this year. Industrial, we're stuck in a very small trading range right here, probably for the rest of the year. XLP, consumer staples. Oh, I got these confused with the other one, but consumer staples, food, Procter and Gamble, stocks that are people buy every day, and they won't stop buying them. They did good last year, but they have high dividends, but they're pretty much stuck in the trading range this year. In the financial, I'm surprised this is down more. This is we're pretty much at the bottom end of this range. After today's huge rally, we'll probably be up here. This is an example of the sector that's out of favor. It's the most out of favor for this year, I think. The bank shares. So I'm already invested in banks. They paid me a dividend in my portfolio, and I don't have a really good understanding to buy more of these, so I'm staying out of this industry. You see, utilities. These were very conservative last year. They paid a high dividend, and they were consistent, maybe 1% growth. But as interest rates peak and start going down, these are going to be out of favor because there's not a demand for that. Real estate, it's stuck in that same trading range. And energy. Today, we learned that the economy is doing good with the jobs report. So as that reports show that the economy is doing good, the price of oil is going to go up, and the energy is going to resume that uptrend. But right now, it seems like that's stuck in the sideways too, while the economy is undetermined. Okay, so we're watching Brazil too. This is the Brazil ETF. We know it's yielding like 15% or 14%. Doesn't look like it's going anywhere. It has like a little bit of a downward trend. I'll have to break down what are the holdings of the ETF to see if it's even worth looking at some more. But right now, this is seems like it's making lower highs, lower lows. Uranium isn't really performing like Dan now suggested. He said it would be the top performer, but it's going sideways. So I guess as the price of oil goes down, less people are interested in building new nuclear places, because if there is cheap oil, then what's the use of being efficient with uranium? I don't know. Let's see. Gold, as the U.S. dollar goes down, it seems like the price of gold is going up. But right now we're in an uptrend. I guess if you can turn out, I didn't draw this, but we're kind of in a sideways pattern with gold too. Okay, that's it for the. I'm going to go over these stochastics for the stocks that we're following too, and it's very similar. We still have this uptrend. We're at a point right now where if we break through some of these channels, like here, then we start an uptrend. Otherwise, we're still sideways, and that happens with every one of these stocks we're following. Abbott Laboratories, it's kind of in a sideways downtrend, probably because it outperformed last year, and this year it's all the drug stocks are going to be out of favor because with lower interest rates on the horizon, tech stocks will be resuming like the growth part of the stock market. Alibaba is sideways; it isn't going anywhere. Let me see. Alphabet. We've been looking at this, as possible uptrend. Right now, Alphabet has its first real major competitor in like 20 years. That ChatGPT from Microsoft, that could be something. It could be a slow-moving train wreck, as they say. This Google, it might be if it starts taking market share away from Google. Their business model might be affected to a point where they have to, they'll be losing some of their market share. So the big problem with Google's technology, they count on you clicking on, one of their sites they recommend, and then clicking on more things to find out what the solution is. Whereas ChatGPT and Microsoft, they're trying to make you ask a question and get your answer all without clicking on websites. So Google has to figure out a way to make AI the same product as ChatGPT or make a similar product so that people stay on their platforms. I don't know.
Google already have something equivalent with ChatGPT internally.
Yeah, they have that Bard product.
Yeah, so they already have it in their own product and incorporate in their own product too. So if you do a Gmail, you're gonna see some filter there, some AI filtering too.
Oh, I didn't know that. Okay, so there was an all hands meeting like a month and a half ago for Google. They said we got to get this AI as a top priority. They merged their AI groups together. They have a couple groups in the company. They merged them all together. They're trying to throw all the resources at countering this new countering the new challenge to their business model. Now, the way I think of this, I have a pretty sizable position in Google. Let's look at a portfolio and let's see. Hold on, Greg's Holdings. Okay, so these are examples of I basically bought Google in 2008. If I sell it now, I'll have to realize like gains from like 15 years. But if I have like a 20% position in Google and they're starting to lose market share, I have to be aware of that and possibly start reducing the position in Google and start putting it into other diversified, other things that could diversify my portfolio a little bit. So that's why we have to follow the news every week and see if there's challenges to business models and see, in your mind, where the company's going to be in 20 years. Like, let's say for Apple, I think Apple is still going to be, they're going to probably make a new product in every 6 years they make a new product, a major product category. Like, I think they're going to make a wearable, what do you call that? Where you interact with your environment. So you put it on your eyes and you can see things around your environment. They're going to come up with something like that. That could be next, portion of the portfolio. But I see in 20 years, they're coming out with something new every 3 to 6 years, and that allows them to grow at least 6% a year. And as long as you have that viewpoint that they're still growing and they're still going to be growing bigger and having more products and services, that's why, well, I have like a 90% confidence level in Google and Apple right now. But if you start having an 80% confidence level in Alphabet, or 70%, as they lose market share, you have to say, okay, well, is it worth having 19% of Google in my portfolio? You got to start diversifying into maybe Eli Lilly, so that you have more of a diversified part of your portfolio. So, but what Warren Buffett is doing, he has 40% of his position right now in Apple, and it's growing every year because Apple just Warren Buffett likes Apple because they keep buying back stock. They authorized a $90 billion stock buyback this earnings report. So that means, for me, this is making up 20% of my portfolio. I own more of Apple every time that they buy back their stock. So right now I have like a 0.00001% position of Apple's total outstanding shares, but that grows a little bit every time they buy their shares back. So not only do I have this vision of Apple growing, I know that my shares are more valuable every quarter when they buy back their shares. But Google doesn't. They buy their shares back too, but it's a possibility that they're going to be losing some market share. But right now they still have a monopoly, and I'm going to keep. That's why we have to keep our eyes on those news stories to make sure we're not. They're not going to really lose that monopoly they have now. So, but I'm not selling Google right now, but I know Jim Cramer suggested that he's selling some of his Google holdings that he's held for like 20 years. So, let's look at what else. We're almost at the end of our time. Okay, I think we're almost at the end of our time. Let me look at anything else. No, I have that. All right, so I think that's it for today. I hope you have a really good weekend, and I'll see you next time.
Yeah, thanks, Greg. I thought the discussion of Eli Lilly was interesting, so thanks a lot.
Oh, super. Well, I don't know. I like to look at the numbers, but I think let's look at one more thing. The Eli Lilly part of my portfolio, it isn't that much. Let me see. Is this mine? No. Okay, so Eli Lilly, right now it's at 1.4% of my portfolio, but it's grown so much since I updated this. It's probably 2%, and I think next week, I think what we'll do is we'll look at our growth chart, our where is it? Hold on. I think it's important to keep track of the sectors that you own. And right now, the majority of what we've been talking about since I started this is tech stocks, because they're the highest growth and I understand them the best. We have a good formula for understanding those. But drug stocks are also could be high growth, but understanding the demand of those going in the future it's kind of not as predictable, but it allows you to at least put a little bit of your money into different sectors. So whenever all the tech stocks went down last year, at least you had a little bit of drug stocks that counterbalance that, because drugs went up last year. So anyways, that sounds great. I'm glad that helped out a little bit. So if you have any stocks in the meantime you want me to look at, let me know, and I'll put them through the ringer like this, like the Lilly. All right. Well, thanks again. And any other comments? Any other things you want to go over or anything? All right. I'd say that.